Um, Hello, welcome back to the continuing lecture in investment analysis. Um, in our last session, I said I would try to track down the original source data to verify these regression results. And actually, it looks like um, I can't, it looks like there was no original source data. It was just given um, basically, excess returns were given, right? Excess returns data were given, uh, and uh, the cumulative returns, geometric average, uh, uh, arithmetic average were given, and but that's not the direct uh, source data to run the regression, because the specification, as you can look at from the specification of the model, uh, in the Fama-French model, right? Other than the market risk premium, the others are not risk premiums. The others are just, they are not risk premiums, but they are premiums, kind of, but, like uh, small firm size premium, or book value to market uh, price premium, not, the risk premium over the risk-free return, right? Uh, so they are not exactly, see, the monthly excess returns, uh, these are not the source data for exactly the source data for uh, running that regression model. Uh, and because I and since I can't verify where they got this, I mean, the original data, I know where they got this, data from, but it's basically, uh, I'd have to, I can also exactly emulate the same result, but I'll have to go back to the like Google and a small to find a small firm, large firm, high market value, book low market value. I mean, this is gonna take uh, another arduous, data uh, collecting task, right? That's why um, they are saying, here it's more difficult to apply, because you have to, first of all, you have to, small firm premium cannot just come from one single company data, right? You have to make, you have to collect data for, um, like, S&P 500 small cap, right? Um, companies, and then S&P 500 large cap companies, and then you have to uh, uh, if there are like 100 small firms in S&P 500, right? You have to collect the data for 100 companies and uh, uh, calculate returns and find average of them, and then again you have to do the same thing with the like 100 large firms, large cap companies in S&P 500. And all of these things are extra steps. I mean, just to have the data ready to run this regression, it takes a lot of uh, extra steps. So that's why it is more difficult to apply. And but anyway, there so there small firm premium was 2.5, and the high market value to book value premium is 4%, and plugging that into this this model, right? And then they arrived at this result. And that is also, the summary statistics is here. And I was also wondering, okay, once you run the regression, you will get the estimates and the estimates of beta and also their standard errors. Of course, this I should have put. I think I should have put. I should have put this first, right? I didn't want to have only the data first, because this is the regression result and the beta, right? And they are comparing. They compared basically two single factor model and two factor model and three factor model. Now, to show how it improved, as you can see, this is a capm using S&P 500 as the regressor or explanatory variable. And of course, the market beta was, we have only one beta because only one explanatory variable, 1.2. In a two-factor model, 1.16, and three-factor model, market beta is 1.51. So you might say, oh, looks like even market beta improved, right? And correlation coefficient, right? Or you see, as the explanatory variable increases, the fit would generally be better. Fit. But once again, it's the overall F statistics that should have improved. I don't have F statistics here, but generally you can see the fit is better. The fit is getting better, right? And then of course adjusted R square is better, right? Residual standard error, in other words, the error residual, right, or the error terms, error of forecasting is getting smaller, right? Alpha, looking at the uh, alpha value is estimated small, but again, it's t-value. We can, if you divide this by this, divide this by this, and that's the t-value. And the way it is, t-value has, significantly improved. I mean, none of the t-values of the alpha is statistically significant, right? Now, this market beta, you can tell this significant, right? We can already tell this will be greater than, t-value will be greater than 2. And the t-values are relatively, this one, size beta, size premium, t-value is like 0.5, right? Ignore the negative. Negative simply means there's a negative correlation between uh, uh, size premium and uh, the excess return on Google, right? And book to market beta is also has a negative correlation, right? Uh, but again, this one is statistically significant, but not this one. So hence, all these, standard errors come from that regression result. And according to this, uh, uh, Google's expected return is 5.24, right? And if think about it, the risk-free, because risk-free rate is 2.75, that means Google's risk premium would be about 2 point something as well, 2.5 or something like that. Currently, however, it is difficult to hold prescribed optimal portfolio because there is no vehicle. There are no vehicles, there exist no vehicles, index funds or ETFs to directly invest in small, the size beta, size premium, and the market price to book price premium, right? I mean, this is the data we have, artificially, the authors have artificially collected. Well, Pharma French have, not the authors, but but these two scholars, Pharma and French, have collected. But, there is no vehicle, right, to observe these, uh, these variables, right? And invest in small stock portfolio. And another way, but we already talked about this. Another way to interpret small size, the size premium is use short sell, right? Short sell large stock portfolio. Short sell large stock portfolio, and invest in small stock portfolio, right? That's the only way we can I mean, that's another way we can operationalize this variable, right? Um, but again, this is not an exact. I mean, still, you will have to. Uh, there are, large cap index funds, large cap index funds. There are small, also small cap index funds. So um, you can, and of course, there are the number of stocks in that index funds must match. Uh, Again, that or at least in terms of weight in the market, they must match. But obviously, then uh, if the weight in terms of weight, if they are uh, if they have to be comparable in terms of weight, then that means you will have like five stocks in the large cap portfolio, large cap index fund, and you will have like 200 uh, companies in small cap index fund. I mean, how this is in reality, this is something that you can't find in reality. How can you conveniently? I mean, are there? Does there exist conveniently an large cap index fund with like five companies in it to exactly match the weight of the small cap, right, index fund with about 200 uh, small cap companies? They don't exist. So that's why it is difficult to uh, actually observe something like this. And also you can do buy value stocks and short growth stocks. First, it should be actually, they should be switched. You should say short growth stocks first, and with that, per-seasonal buy value stocks to substitute for HML. Again, unless unless you actually use your money to do this, I mean, it's hard to there's no way you can observe directly this because you must find some hedge fund that short growth stocks. You must right, and then this hedge fund must use that proceeds to buy value stocks. And how do you know what hedge fund is doing that? I mean, hedge funds are generally doing it very, you may be able to collect, you may be able to find them, but are they exactly uh, are they will they be behaving exactly like that? Short when they short growth stocks, and they and how many of them, right? Uh, how many companies do they? How many companies do they growth companies do they short? And how many? And what would be the fund size? I mean, it also depends on the fund size. If the fund size is uh, 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 relatively huge, they can do this on a large scale. So it can represent the entire growth stocks in the market. And if they exactly invest the proceeds into the entire value stocks in the market, then they can represent our variable, right? But again, hedge funds vary in sizes, and they are very secretive. They don't reveal their strategy, right? So it's hard to observe. So it's no small feat. It's no small feat. Because of that, it's no small feat. The single index model still dominates the investment industry. If forecasts of these additional factors are themselves subject to forecast error, again, uh, these are forecasts, right? Uh, these are forecasts themselves, right? Then therefore they are subject to forecast errors, right? These forecasts are also subject to forecast errors. Then these models will be less accurate than a single index model, right? So that's why. Uh, that wraps up everything about the multi-factor models, and we're finally moving on to the APT, or arbitrage pricing theory. Okay. Oops, what happened? This is not what. Oh my God. This is not the. Oh, come on. Oh, oh, oh. Well, I'll have to do it anyway. This was not the latest PowerPoint that I have updated. Um, oh, I don't. I should have recovered. Um, so this is all my work that it's gone. Oh, how can it be? Uh, this is a older version that was, uh, but anyway, I'll just have to do some extra work. So, if this is and this is an older version, so it may not be most accurate, or I mean, I updated it, or I revised it to be more easily read and easily understood. Uh, and that latest version is gone. And this is the one before it, so it may not read very smoothly or uh, very easily understood. But that's I will have to make up for that. Anyway, so what does arbitrage mean? Arbitrage is a an opportunity to uh, risk make money risk free, right? Uh, without using your own net investment without any net investment. So basically, arbitrage is an act of exploiting mispricing of securities to achieve risk-free profits. Let's think about it. We've seen the examples all along, and in the models that we have used, like shorting, growth firms, and in using that proceed to invest in large firms, invest in value firms and things like that. That is, basically, arbitrage, because you don't have to use your own money, right? In that case, but again, it's not risk-free. That example was not risk-free, and also, you're not. The arbitrage in the arbitrage pricing theory is investing in the same security, right? Taking advantage of the mispricing in the same security in two markets, right? So the example in the farmer-French model is like, short the growth stocks and invest in value stocks. They are two different securities, right? Two different securities. But here, that's still arbitrage. It's not perfect arbitrage because it's not risk-free. But in arbitrage pricing theory or arbitrage pricing model, you are trying to exploit the mispricing, right? To achieve the risk-free profits. So you take long position in cheaper market financed by short position of the same security in the expensive market. Then that's definitely a sure profit making strategy. Why? Think about it. If you short high, that means you're selling high, and with the proceeds, you buy the same security that is priced low. Then, obviously, you bought low and sold high. You bought low and sold high. So it's definitely show profit. And you might wonder, is it possible? Can that happen? Well, it also, yes, because, market is not perfectly efficient. Again, I don't think we're going to have time for efficient market hypothesis. I didn't even put it on the syllabus, because if we ever have any time left, then there's enough time left. I would rather want to go to options, right? Options and futures, but efficient market hypothesis is something relatively easily studied on your own, right? But I already mentioned this. Efficient market hypothesis, assumes that the market is strong form efficient. And there are three forms of efficiency: strong form, semi-strong, and weak form. Reality is not strong form efficient. Reality is, somewhere between semi-strong and weak form efficient. But if the market, and because the reality is not strong from efficient, there are opportunities to make money. There can be mispricing, opportunities to make money in the short run. I mean, buy low, sell high can also happen in the short run as long as there is mispricing in the market, right? Otherwise, low, short, buy low, sell high, which is called long position, right? Or go long strategy. It can happen only in the long run market, in the long run, right? And again, if as long as the economy is growing, that strategy will always work in the long run. But people also want to make money in the short run. They are all, of course, a lot of people are doing day trading, right? Intraday trading, But it averages out eventually. If you're a day trader, sometimes you make money, right? Sometimes you lose a lot, Then sometimes you make money again, and so I mean, if you're buying and selling, like 6 times during the day's trading, overall, what do you think is your overall return? Your overall return may be, zero. I mean, your losses and gains will all, cancel out, and uh, that market timing. I mean, during the day, even if you're a day trader, like buying and selling 6 times, trading 6 times, that is very high, high frequency. I mean, maybe twice, 2 or 3 times, 2 or 3 tradings per day, on average, But the word arbitrage, also think about it. There's a term, it's a legal term as well, arbitrager. What's an arbitrager? Arbitrager is someone, it's like a negotiator, right? But how would you arbitrage between the two parties? The two arbitrager is someone who is like acting as a mediator, right? And what does that mean? Two parties, the buyer or seller, or let's say the management and union, management versus union, right? Of course, there's a big gap between the management's position and the union's position, right? Big gap between the buyer and seller. And what is the role of the arbitrager in labor dispute? Arbitrager is someone who mediates the difference. In other words, closing the gap, bridging the gap between the two. So in a way, you can think of it this way. If there is a mispricing, right, that's a gap. And that can be arbitraged. In other words, you can rake, or you can benefit that gap, because you come in the middle and you benefit from that gap. That's why it is called arbitrage, right? Okay, so I guess we cannot. We will have to. We cannot continue. We will have to do this in the next video. Alrighty. That's it for today, and I mean, that's it for this segment of the video, and I will see you guys in the next video.